Hi, I'm Chris Cebula, and I'm here with Mark Armbruster. We're talking today about the stock market and how there are a number of similarities with the late 1990s. Mark, what are you seeing out there?
Hey, Chris. I'm seeing a lot of craziness. Just 5 stocks now account for over 20% of the entire market value of the S&P 500. There's irrational trading in stocks of bankrupt companies, and there's a lot of highly speculative trading going on by uninformed investors. Interestingly, these were all hallmarks of the 1990s as well, when the technology boom eventually got out of hand. Its stock market valuation grew to its highest level ever by a lot.
You're, of course, referring to Hertz, which declared bankruptcy and noted that stockholders were likely to lose all of their money, yet the stock inexplicably traded up to over $5 per share. Chesapeake Energy is another one. The company has not yet declared bankruptcy, but is likely to do so in the near future. But that didn't prevent the stock from rising to almost $70 per share from $13 in just a few days. Traders on the new Robinhood trading platform are being blamed for a lot of this activity. There are reports of middle schoolers trading and driving up the prices of stocks to crazy levels.
Yeah, it seems insane. It reminds me of the late 1990s when I was working in New York City. On a Saturday morning, if I was going to go to work, I'd get in a taxi cab and give them the address at 388 Greenwich Street. Invariably, the driver would say, Smith Barney, and he'd spend the rest of the ride talking to me about trading stocks or speculating in commodities.
Nikola is my favorite. It's a public company that plans to sell electric pickup and semi-trucks. The company doesn't have any sales at this point and isn't ready to begin manufacturing them, but the market value of its shares is around $25 billion. Ford, on the other hand, is a 100-year-old company that sells lots of trucks, and its market value is virtually the same.
Yeah, Navistar has around a 20% market share in the big rig truck market, but it's only worth $2.5 billion. It just seems nuts.
Still, things seem more rational than the 1990s.
True, strong performance by technology companies isn't necessarily a problem, but it can get out of hand. Tech companies these days have generally been solid companies, unlike the era of the 1990s when you had companies like Pets.com as publicly traded firms, despite a business model that showed no promise of ever making money. But at least they did have revenue, unlike Nikola. There's still some sanity in the market today. Companies like Microsoft, Apple, Google, and Facebook all have price-earnings ratios above that of the overall market, but they're not insane. And these companies deserve to trade at premiums since they're strong firms with solid revenue and earnings growth. You also have companies like Amazon that trades at 126 times earnings. Netflix trades at 90 times earnings, and Zoom trades at over 1,400 times earnings. It seems unlikely these companies will ever make enough profit to justify these valuation levels. And this problem isn't limited to just a few names. The Nasdaq 100 index recently hit a new all-time high and is trading at a PE ratio at the high end of its historic range. This despite a global pandemic and social unrest throughout the U.S. that are causing a lot of economic uncertainty.
In the 1990s, it seemed there were no real reasons for stocks to keep rising. It was just sort of a tulip mania situation. However, there are good reasons for some of what we're seeing today. The Fed has been pumping liquidity into the economy at an unprecedented rate. All that liquidity and strong demand for the best deals is driving up valuations for private equity investments. This ultimately spills over into the public markets and drives up values on many tech and biotech stocks. Borrowing costs remain low, and there is an insatiable search for growth.
Right, many of those dynamics were true in the 1990s as well. There was low inflation, Fed policy was accommodative, the Greenspan Fed cut interest rates ahead of the Y2K. Silicon Valley was booming back then, and there was also an insatiable search for growth companies. Unfortunately, that didn't end well for the stock market, as it fell over 50% between 2000 and 2002.
Yeah, I don't think that means we're in for a similar collapse today, but future returns do seem likely they'll be more modest than in the past. This table shows stock market returns broken out by segment and decade. You can see that the returns for all stock market segments were strong during the 1990s, but they were particularly strong for large-cap growth stocks. The decade of the 2000s was the reverse. Most market segments provided lower returns, but large-cap growth really struggled with annualized losses of 4%. The 2010s looked a lot like the 1990s, and with today's high stock market valuations, it appears the next decade could resemble the weak market of the 2000s.
Right, and today's high stock market valuation is a strong headwind. This graph shows the relationship between the CAPE ratio, which is the cyclically adjusted price-earnings ratio, and future 10-year returns for the S&P 500. There's a clear downward trend in returns as valuations rise. And in fact, when the CAPE has been at today's level in the past, the range of future returns was between a loss of 7% annually to a gain of 6% annually. So even the best case scenario would provide returns that are far below what we've enjoyed historically.
In retrospect, the best thing to have done in 1999 would have been to sell out of the market. Should we be considering that today, Mark?
I don't think so. Despite today's high valuations, this cycle may end differently than the 1990s. And even anemic returns are better than zero returns that you would be getting in cash.
Can't really forget about inflation, right?
Right. And there are some actions investors can take to tilt the odds in their favor. Certainly being diversified and not overly concentrated in large cap U.S. growth stocks seems prudent at this point. And factor-based investing could also help. This table shows that when returns have been weak in the past, such as during the 1970s and the 2000s, investing in factors such as smaller cap stocks or value stocks or stocks with strong profitability would have boosted returns. If there's a change in leadership soon away from the largest growth stocks, which seems likely, these types of factor-oriented stocks could help improve returns going forward.
So if you're a conservative investor, don't chase the most highly valued stocks. Use a factored approach, and continue to diversify into other asset classes. If you're more aggressive, party like it's 1999. Try to ride the wave for as long as you can. Tech could get even more expensive, so you could buy high and sell higher. And speculative opportunities could be fruitful for some.
But you better watch out when the music stops.
And when the tax man comes knocking. In summary, the investment world is getting a little nutty. There are opportunities to make a lot of money in the short term, but they seem very risky. For the more prudent among us, the old common sense approaches of value investing and diversification make more sense than ever. Give us a call if you want to talk in more detail about this or any investment-related topic. Thank you again for joining us today, and we look forward to having you tune in to future ACM Invest Ed episodes.